Welcome back to the exam war room. Look, if you're an IGCSE Accounting 0452 candidate and you're aiming for that elusive A-star grade, you are in exactly the right place. Today's explainer is a high-octane mentoring session, and we are zeroing in on Module 11, Statements of Account and Receipts. We're not just going to memorize facts today, no way. We're going to master the fundamental architecture of accounting, decode the exact strategies examiners are looking for, and make sure you're totally bulletproof for your exams. So let's get focused and conquer the syllabus together.
Here's a quick look at our agenda. We've got 6 key areas today: core architecture, technical execution, AO3 interpretation, modern fintech, examiner pitfalls, and finally, the A-star challenge.
Okay, let's dive right into Section 1, the core accounting architecture.
As a subject specialist, I have to tell you right out of the gate that top marks absolutely require flawless terminology. For the 2026 and upcoming 2028 to 2030 syllabus updates, Cambridge has firmly transitioned to modern international terms. You have to say irrecoverable debts instead of bad debts, and owner's equity instead of just capital in certain contexts. It's literally a non-negotiable requirement for an A. Using outdated language just signals to the examiner that your knowledge is stuck in the past, and we definitely don't want that.
So the crucial point here is how these definitions actually tie into our core principles. Think of it like this. Every single transaction has a duality, right? You always have to maintain that accounting equation. Assets equals liabilities plus equity. It's like a perfectly balanced scale. You've also got to strictly apply the business entity concept, keeping personal and business finances totally separate. And, oh, this is a big one, the prudence concept. Don't overstate your profits, ignore potential losses, and your profit is artificially inflated. Plus, stick to the historical cost principle. This isn't just dry theory, it's the exact lens you need to view every complex paper 2 scenario through.
Let's move to Section 2 and see how this builds: technical execution and method marks. Okay, I'm putting my examiner's hat on for a second. The technical execution of these statements follows a very strict step-by-step procedural flow. You start by identifying the source document, like an invoice or a bank statement. That feeds straight into your books of prime entry, which then populate the T accounts, and finally, you arrive at the trial balance. Now here's your secret weapon: method marks. In the IGCSE exam, you can actually earn method marks even if your final balance is completely wrong. How? By making your logical flow 100% visible to the examiner. If you clearly show your workings through this chain step by step, you're going to rescue points that other students just carelessly throw away.
Now, right in the middle of that flow, the T account structure is still the absolute gold standard for the double entry system. You've got to master the art of balancing these accounts perfectly. Knowing exactly when and where to drop a balance BD, that's brought down, versus a balance CD carried down is fundamental. You want 100% accuracy here because that guarantees a perfectly seamless transition right into your trial balance.
But watch out, because mathematical pitfalls are literally everywhere during this procedural flow. A classic mistake? Confusing trade discounts with cash discounts. Keep in mind, a trade discount is just a bulk buying reduction that happens before the accounting records are even touched. A cash discount, on the other hand, is a prompt payment reward that you absolutely must record. If you miscalculate the percentages between these two, those errors are going to cascade through your entire ledger. Keep them completely separate in your mind, and more importantly, in your workings.
All right, Section 3, AO3 interpretation and ratios.
Assessment Objective 3 is all about interpretation and evaluation. Look, any candidate can memorize a formula and crunch a ratio. That's just the baseline. What separates a B grade from an A-star is figuring out what that ratio actually means for a business in the real world. Let's say you're looking at a paper 2 scenario, right? A business's current ratio has drastically fallen from a very healthy 2.5 to 1 down to a really concerning 1.1 to 1. You've done the calculation, great. But what does that number actually tell us about the survival of the business?
And this brilliantly illustrates how we move to high-level evaluation. You have to play detective and hypothesize the root causes. Did the business overpurchase inventory that's now just sitting uselessly in a warehouse? Are they settling trade payables way too slowly and ruining supplier relationships? Or maybe their cash reserves are totally depleted from some massive capital expenditure. Moving from just spotting the problem to actually evaluating it, that's what locks in those maximum AO3 marks. You also need to understand inter-firm comparisons for AO3. Not every business uses the exact same accounting policies. For instance, one firm might use the straight-line method for depreciation, while their competitor uses the reducing balance method. That makes comparing them numerically super tricky. As an A-star candidate, your job is to look beneath those surface numbers and analyze the true quality of the profit they're reporting.
But remember, the numbers only give you half the story. You have to bring in non-financial factors too. We're talking about things like staff morale, the physical location of the business, its overall market reputation. None of these show up in the accounting records, right? But they're absolutely vital for evaluating a business's long-term sustainability and its true return on capital employed, or ROCE. Always, always weave these qualitative factors into your final evaluation paragraphs.
Moving right along to Section 4, Modern FinTech and AI Application. Now, what's really interesting about this is stepping out of the textbook and looking at 2025 business practices. In the real world today, AI-driven accounting software, like Xero, is already automating prime entries and T accounts by automatically categorizing bank feeds. So why do we even study this? Well, it validates this whole explainer. Even when AI is doing the heavy lifting, financial professionals still have to deeply understand the core architecture so they can spot anomalies and verify that the AI is actually getting it right.
Okay, listen closely for Section 5, Examiner Warnings and Pitfalls.
I am going into strict senior examiner mode right now because students are hemorrhaging points every single year for the exact same tragic mistakes. Straight from the principal examiner reports, quote, students often lose marks through poor handwriting in ledger accounts. I know, it's a surprisingly low-tech reason to lose an A-star, but seriously, if the examiner cannot clearly read your numbers or distinguish your state symbols in manufacturing accounts, you will not get those method marks. I don't care how brilliant your internal logic is. Absolute neatness is mandatory.
Here's another massive pitfall they highlighted: the critical failure to distinguish between revenue items and capital items. Let's recap. Revenue items are your day-to-day running costs. Capital items are your long-term asset purchases. If you accidentally log a huge capital asset purchase as a daily revenue expense, oh boy, your final statements are completely derailed and your profit is going to be drastically understated. You have to categorize these flawlessly. Now, exam pressure is real. It can make even the best students totally blank on the basics. So you need a bulletproof exam strategy, a memory hack. Whenever you're stuck, remember the mnemonic dead click. Debits increase expenses, assets, and drawings. Credits increase liabilities, income, and capital. Locking this into your brain will help you survive that exam room panic, manage your time, and keep your double entry accuracy absolutely perfect. Finally, Section 6, the ACE Challenge. We have covered an immense amount of ground today, from the core principles of prudence and duality to the magic of method marks, all the way to AO3 evaluation. Now it's time for you to apply it. I want you to pause and think about this trick question from a past paper. How exactly do year-end adjustments for accrued expenses, prepaid expenses, and the concept of realization directly interact with the prudence concept in a really complex Paper 2 scenario? Think about how missing an accrued expense directly violates prudence by artificially overstating your profit. You need to work through that entire logical chain in your mind before exam day. Master this level of synthesis, and honestly, that A-star is yours for the taking. Thanks so much for joining this explainer. Keep studying hard, and we'll see you in the next one.